Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Here on the Deep Dive, we sift through a whole stack of information to really pull out the most important nuggets of knowledge. We want to give you a valuable shortcut to being truly well-informed. Today, we're plunging into, well, quite a whirlwind of financial headlines from August 6, 2025. We're pulling insights from sources like CNBC, Bloomberg, and Yahoo Finance. Our mission for you today is to really unpack this intricate dance between global trade policy, corporate performance, and the underlying market sentiment. By the end of this, you should have a much clearer understanding of what's driving these headlines and maybe more importantly, what it all means for the broader economic picture. So let's unpack this.
Absolutely. It's definitely a day where you see these large-scale macroeconomic trends bumping right up against very specific company results. And it's all deeply intertwined with this ongoing narrative of international trade and, well, policy decisions. We'll try and connect those dots for you, help you see not just what happened, but, why it really matters today.
Okay, let's kick things off with the big picture then. U.S. Treasury yields, they're ticking higher this morning. Looking at the data from CNBC, the benchmark 10-year note yield, it was up 4 basis points to 4.24%, and the 30-year Treasury bond yield climbed more than 5 basis points to 4.82%. This is as of early Wednesday, August 6th. Now, this rise is happening right before the Treasury Department plans to sell a pretty hefty chunk of new bonds this week. We're talking $67 billion total, $42 billion of 10-year notes, and $25 billion of 30-year bonds. So what's going on here? Why are yields climbing right now, especially with this big issuance coming up?
Yeah, what's really fascinating here is the mix of factors pushing those yields up. It's creating a complex situation for the market. One big piece of the puzzle, and CNBC highlighted this, comes from recent economic data, specifically the ISM non-manufacturing PMI for July. Now, the overall index actually fell slightly to 50.1. That was below expectations. But, and this is the key part, the prices index within that same survey, it jumped. Rose 2.4 points to hit 69.9. That suggests that even if overall activity is maybe softening a bit, these inflationary pressures in the services sector are proving much stronger, more persistent than people thought.
Right. And that's where the deeper context comes in, isn't it? Because if you dig into that ISM report, you also see things like new export orders falling, and the employment index slipped further into contraction. So slowing growth signs on one side, stubbornly high prices on the other. Deutsche Bank analysts, CNBC noted this. They called this ISM data worrisome. They suggested it, quote, raised renewed concerns that tariffs were pushing the U.S. economy in a more stagflationary direction, complicating the Fed's job in the process. But hang on, if the overall ISM index fell, couldn't you argue the stagflation worries might be a bit much? Or is it really just that one prices index telling the whole story?
That's a really crucial question, and it brings the Fed's dilemma right into focus, doesn't it? The concern isn't necessarily that stagflation is like a certainty, it's that the risk has gone up. And even small signs of it can be incredibly disruptive for policy. Stagflation, for anyone needing a refresher, is that kind of nightmare scenario for central banks. Right. High inflation, stagnant growth, high unemployment all at once. The Fed has that dual mandate, manage inflation and employment. So when you see the price part of a key index like ISM services jump significantly, while at the same time export orders and employment are weakening, it puts them in an almost impossible bind. If they tighten policy to fight inflation, they risk slowing growth even more, pushing up unemployment.
Right.
But if they loosen policy to support growth, they could just make inflation worse. And we know Fed officials, Boston Fed, Susan Collins, San Francisco Fed's Mary Daly, they're speaking today. Everyone's going to be watching their comments really closely for any hints on how they plan to walk this tightrope, especially with the extra complication of tariffs stirring the pot, directly feeding into those price pressures.
Okay, so from those broad macro strokes, let's pivot. Let's look at how these forces are actually playing out, down in the corporate trenches, particularly in tech, where recent earnings reports are painting quite a vivid picture. Advanced Micro Devices, AMD, they reported their Q2 earnings. CNBC and Yahoo Finance covered this. On the surface, kind of a mixed bag, right? They slightly missed on adjusted EPS 48 cents versus 49 expected, but surprisingly, they actually beat on revenue, pulled in $7.69 billion against a $7.42 billion expectation. Despite that revenue beat, though, Reuters noted their stocks slid about 5–6% in extended trading. What does that tell us, that mixed reaction?
It tells us that while, yes, revenue growth is good, the market is absolutely laser-focused on profitability, and maybe even more critically, on future guidance, especially in a sector that moves as fast as AI. If we connect this back to the bigger picture, what's really crucial for AMD isn't just the Q2 numbers. It's the reasons for any misses, and crucially, their forward outlook. Now, AMD actually gave a better-than-expected Q3 sales forecast, $8.7 billion, plus or minus $300 million. On its own, that signals continued strong demand. Okay. However, a big drag was their AI business revenue. It actually declined year over year. Why? U.S. export restrictions on their MI308 AI chips going to China. CNBC and Yahoo Finance reported this cost AMD a substantial $800 million just in the June quarter, and it resulted in an operating loss for that whole segment. It just vividly shows how even really strong underlying demand can get hammered by geopolitics and trade policy.
What's really interesting to me, though, is that even with these headwinds, these export controls, AMD CEO Lisa Su is still forecasting AI revenue growth for this current quarter, and their outlook doesn't even include that MI308 revenue. What does that specific detail tell us about the real underlying demand for these chips, even when supply is choked off? And what about the whole AI market?
That's exactly the critical nuance here. It tells us the unconstrained demand for AI chips is just explosive, almost regardless of the geopolitical friction. The fact AMD can project growth without revenue from a major restricted product line. That speaks volumes about the sheer hunger for AI processing power. But this isn't just an AMD story, right? We also saw Supermicro Computer, another key player in AI servers. Their stock took a huge dive.
Yeah, I saw that. Big drop.
Plunged around 13–17%, according to Reuters. They missed their own Q4 results, gave weak guidance. Now, that was blamed on a mix of things. Internal execution, delays getting NVIDIA chips, more competition. But Reuters also specifically pointed out that Trump's tariffs played a role there, too. These aren't just isolated incidents. They're symptoms of, well, a rapidly fragmenting global tech economy.
So how do these specific companies' struggles, some driven by politics, square with the almost parabolic rise we're seeing in the broader AI boom? It feels kind of contradictory, doesn't it?
It absolutely does feel contradictory, and this is where you get the deeper insight, I think. Yeah. The AMD and Supermicro stories aren't just about earnings misses. They highlight a critical new reality for these tech giants. Market dominance now hinges just as much on navigating geopolitical minefields and export controls as it does on, pure innovation. Companies aren't just competing on tech anymore. They're competing on their ability to adapt to this fragmenting global economy. So while AMD and Supermicro hit these headwinds, the overall AI sector just keeps climbing. Take OpenAI. CNBC reports they're in talks for a secondary share sale, valuing them at a staggering $500 billion.
Wow, $500 billion, up from $300 billion just earlier this year.
Exactly. And their ChatGPT platform is apparently set to hit 700 million weekly active users. It just perfectly illustrates the disconnect. Incredible innovation, massive demand. But supply chains and international policies are creating these severe friction points for key players. It makes it a really tough environment to operate in. And just to underscore how intense these export controls are and the desperate demand, CNBC also reported 2 Chinese nationals were just charged for illegally shipping millions of dollars worth of NVIDIA H100 AI chips, the really high ones to China. It shows the high stakes involved.
Right. Okay, shifting gears now to that geopolitical chessboard. President Trump's tariff policies. They're definitely center stage again, and it looks like a doubling down. CNBC's Daily Open newsletter highlighted this, saying he appears to be digging in on his policies. Modified country-specific reciprocal tariffs are apparently set to start as early as August 7th. Duties on India, for instance, set to rise within 24 hours. He's also announced new tariffs coming on semiconductors and chips within the next week or so. Explicitly wants them made in the United States. And we can't forget pharmaceuticals planning a small tariff first, then ramping it up to an astonishing 250% within a year and a half. What's the thinking behind this aggressive tariff playbook? And what are the immediate diplomatic ripples we're already seeing?
Well, the philosophy, as articulated by the former president, seems rooted in this belief that tariffs are a tool, maybe a blunt one, to force manufacturing back to the U.S. and to correct what are seen as trade imbalances. It's very much an America-first approach to global trade, but the immediate impact on international relationships is profound and often pretty volatile. Just look at the U.S.-India relationship. 6 months ago, CNBC reported, Trump and Prime Minister Modi were exchanging warm greetings. Looked like a strengthening alliance.
I remember that.
Trump calls India the tariff king and openly accuses them of fueling Russia's war. India, meanwhile, stresses its own national interests. A former Singapore diplomat, Bilahari Kausikan, noted India sees itself as independent. And India's external affairs ministry called Western criticism hypocritical, pointing to their own trade with Russia. This is a really significant unraveling of a partnership built over 2 decades across multiple administrations, a partnership aimed at countering regional influences, fostering economic ties. The implications of this shift are huge, potentially reshaping alliances in a critical part of the world.
And the impact on business is immediate. It's tangible, right? Like, take Honda, the Japanese auto giant. According to CNBC, their Q1 operating profits got cut in half, a 50% drop. Largely missed estimates, and this was put down directly to these U.S. auto tariffs and a stronger yen. What does a profit plunge like that signal for a company like Honda and for the whole auto industry?
A 50% profit drop, that's a massive shock. It forces immediate strategic rethinking. For Honda, it means reconsidering where they build cars, maybe speeding up plans to produce more in the U.S. to get around tariffs, but that's a long, expensive road.
Yeah, not easy.
For the wider industry, it signals a period of, well, deep uncertainty and likely restructuring. It really validates those fears that protectionist policies, even if aimed at boosting domestic industry, can seriously disrupt these incredibly complex global supply chains built over decades. And that usually leads to higher costs for consumers or, like here, lower profits for manufacturers. And it's not just auto tariffs. What's also fascinating is how these investment pledges from allies are being framed in the same sort of rhetoric. Trump, for example, likened investment pledges from Japan and Europe to a signing bonus in baseball. That's according to CNBC. Claimed Japan's $550 billion package is our money for the U.S. to invest as we like. Said similar things about the EU's $600 billion, calling it a gift.
That's quite a way to frame it, isn't it? Signing bonus, gift. But Bloomberg pointed out there's actually significant confusion here, big discrepancies in understanding these deals. Japan, for instance, apparently sees their $550 billion pledge mostly as loans and guarantees, not direct investment, and meant for mutual benefit, focused on building supply chains within the U.S. Why is that distinction, loans versus direct investment, so important, and what does the confusion tell us?
Oh, the distinction is absolutely crucial. Direct investment means capital flowing directly into a country, building factories, creating jobs, tangible assets. Loans and guarantees, while helpful, are financial instruments. They support specific projects, encourage private investment, often with an expectation of being paid back or mitigating risk. To frame them as our money or a gift fundamentally misrepresents what these financial commitments are. They're typically structured for mutual economic benefit, strategic alignment, not as unilateral handouts. This highlights a really deep gap in communication, maybe interpretation, makes it hard to even assess the true financial commitment. And more importantly, it erodes trust in these high-stakes trade talks. When one side seems to misunderstand or, well, deliberately misrepresent the terms, it creates a very shaky foundation for any future cooperation.
So, pulling this all together, what does it mean for overall market sentiment right now? We saw that pullback on Tuesday. S&P, NASDAQ, Dow all dipped. But there are definitely contrasting views out there. Jim Cramer, for one, CNBC reported, is really pushing back against what he calls Wall Street's knee-jerk negativity. He's arguing companies are doing a bang-up job, profits are bountiful, they're even managing to mitigate tariff impacts. He cited Wayfair as an example. He seems to think the market got over previous tariff losses. And these negatives are often just perceived negatives. Is he right? Is it just negativity?
Well, Kramer's view definitely encourages us to think critically about whether the market is overreacting to these external pressures or if these are, deeper structural shifts happening. It's true, while we've seen big names like AMD and Supermicro get hit directly by tariffs and competition, we also see really robust growth elsewhere, like that OpenAI valuation jump we talked about.
Yeah.
And major players like Disney pushing ahead with big strategic moves, their new ESPN direct-to-consumer streaming service, also reported by CNBC. So it's definitely not a uniform picture of decline across the board. The real question for investors becomes, how do you weigh these short-term reactions, often driven by headlines and, frankly, rhetoric, against the long-term fundamentals and opportunities that might still be unfolding, even with these geopolitical headwinds? The market has shown resilience to tariffs before, suggesting some capacity to adapt, but the cumulative effect of ongoing uncertainty, that adds a whole new layer of complexity.
It really is a dynamic landscape, isn't it? Where the rules of the game, especially around global trade and tech, feel like they're constantly changing, almost in real time. So as we wrap up this deep dive, maybe here's something for you to consider. How much of today's market movements are truly reflecting fundamental economic strength or weakness? And how much is being driven purely by the shifting sands of global policy and the, let's say, often provocative rhetoric that surrounds it? That interplay between fundamentals and policy narratives, it seems like it's going to define the financial landscape for quite some time. It makes looking beyond the headlines absolutely crucial.
Indeed. The stories, the narratives around trade and technology, they're shaping investment decisions just as much as the numbers on a balance sheet now. Your ability to understand both the numbers and the stories behind them, that's going to be key to navigating these markets. Definitely keep a very close eye on how companies continue to adapt, how they innovate amidst all these geopolitical shifts.
We certainly hope this deep dive gave you a valuable shortcut to understanding the complex forces at play in today's financial headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.